Welcome to another exciting video where we decode the complex world of investing. Whether it's stocks, real estate, cryptocurrencies, or any other form of investment, the journey is fraught with potential pitfalls. However, armed with the right knowledge and approach, it's entirely possible to navigate these challenges and find your path to financial success. In today's episode, we're going to delve into a topic that's crucial for both beginners and seasoned investors: the top 7 investment mistakes to avoid. These mistakes can be costly, but the good news is they're entirely avoidable with the right guidance. We'll explore each one in detail, providing you with practical tips and strategies to keep you on the right track. Our goal is to help you build a resilient investment portfolio that can weather storms and provide you with the returns you're aiming for. Remember, I am not a financial advisor. These videos are for educational purposes only. Investing of any kind involves risk. Your investments are solely your responsibility, and it's imperative that you conduct your own research. While it's possible to minimize risk, I am merely sharing my opinion with no guarantee of gains or losses on investments. So, without further ado, let's dive into the top 7 investment mistakes to avoid. 1. Lack of a clear investment plan. 2. Chasing hot tips and market trends. 3. Ignoring diversification. 4. Overlooking the impact of fees and taxes. 5. Neglecting regular portfolio review. 6. Letting emotions drive investment decisions. 7. Failing to understand the investment. Stay tuned as we unpack each of these mistakes, providing you with the knowledge to sidestep these common pitfalls and strengthen your investing strategy.
You don't want to miss this.
All right, let's dive into the first common mistake: lacking a clear investment plan. Imagine setting off on a road trip without a destination or a map. Sounds chaotic, right? That's exactly what investing without a plan can feel like. You might stumble upon some interesting places, but you'll likely waste a lot of time and fuel along the way. Having a clear investment plan is like having a detailed map for your financial journey. It outlines your destination, financial goals, the path to get there, investment strategy, and the fuel you'll need, investment capital. It provides guidance when the market gets stormy and keeps you focused on your long-term goals rather than short-term market fluctuations. So, how do you create an investment plan? Start by defining your financial goals, be it retirement, buying a house, or funding your kids' education. Then consider your risk tolerance and investment horizon. Finally, choose investment vehicles that align with your goals, risk tolerance, and time frame. Be sure to review and adjust your plan regularly as your financial situation and market conditions evolve. Remember, a well-crafted plan is your best defense against investment mistakes. So take the time to create one. Your future self will thank you. Stay tuned as we delve deeper into the remaining common investment mistakes to avoid. You wouldn't want to miss this. Next up, we're tackling a classic mistake: chasing hot tips and market trends. We've all been there, right? A friend shares a hot stock tip, or we see a new trend rising, and the temptation to jump in can be overwhelming. But here's the thing: chasing the latest buzz can often lead you astray from your well-constructed investment plan. Investing isn't about getting lucky on a hot tip. It's about consistent, disciplined adherence to your investment strategy. It's easy to get caught up in the excitement of trending stock or sector, but remember, what goes up fast can come down just as quickly. You could end up buying high and selling low. The exact opposite of a successful investing strategy. So when you hear about the next big thing, pause and consider how it fits into your investment plan. Does it align with your goals, risk tolerance, and investment horizon?
If not, it's probably best to let it pass.
Don't forget, if you're finding this video helpful, be sure to hit that like button and subscribe to our channel for more investment insights. Stay tuned. We got a lot more to cover. Our next common pitfall on the journey of investment is ignoring diversification. Folks, I cannot stress enough how crucial diversification is for your portfolio. It's like the age-old saying, don't put all your eggs in one basket. Why? Because if that basket drops, you lose all your eggs. The same applies to investing. If all your money is in one stock or one sector, you're at a higher risk if that area takes a downturn. Diversification is all about spreading your investments across different assets: stocks, bonds, real estate, commodities, even cryptocurrency. A mix of these can help insulate your portfolio from the volatility of financial markets. Remember, diversification doesn't guarantee profits or protect against all losses, but it does help you manage risk and potentially smooth out your investment returns over time. Think of it as an insurance policy against the unexpected. So don't neglect diversification. It could be a real game changer for your investment journey. Next up, a sneaky little detail that can eat into your profits over time, overlooking the impact of fees and taxes. It's easy to get caught up in the excitement of potential gains and ignore these small things, but they matter a lot. Think of it this way. You're on a road trip and you're so focused on reaching the destination that you ignore the slowly falling fuel gauge. Suddenly you're stuck in the middle of nowhere with an empty tank. Fees and taxes are like that fuel gauge. Ignore them, and you might find your investment vehicle grinding to a halt. Fees can come from brokerages, fund management, transactions, and more. Taxes, well, they're inevitable, but with smart planning, you can mitigate their impact. So take the time to understand the fees associated with your investments and consider the tax implications. It might seem tedious, but it's worth it, and could mean the difference between a profitable and a losing investment. Remember, it's not just about how much you make, but how much you keep. Moving on, let's talk about a pitfall that might seem obvious, but is so often overlooked: neglecting regular portfolio reviews. You see, investing isn't a set, and forget it kind of deal. It's more like a garden that needs regular tending. Imagine planting a seed and then never watering it, never removing the weeds, or never checking if it's getting enough sunlight. What are the odds that you'll find a thriving plant there weeks or months later? Pretty slim, right? Your investment portfolio is that garden. Regular reviews allow you to understand what's working and what's not. Maybe one of your investments has outperformed and now takes up a larger part of your portfolio, leaving you overexposed. Or maybe another hasn't lived up to expectations and needs to be replaced. By regularly reviewing your portfolio, you ensure that it remains aligned with your financial goals and risk tolerance. It's like giving your investments the water, sunlight, and care they need to grow. Remember, folks, stay involved, stay informed, and stay on top of your game. Next, we tackle a monster that haunts many investors: emotions. Picture this. The market takes a nosedive and you panic, selling off your investments only to see them rebound the next week. Or perhaps you hear about the latest hot stock and buy in without doing your research, only to watch its value plummet. These are classic examples of letting fear and greed drive your investment decisions. And let me tell you, it's a dangerous road to take. It's crucial to stick to your investment plan and not let your emotions get the better of you. Remember, the market will have its ups and downs, but well thought out investment strategy will stand the test of time. So, friends, keep a cool head and don't let the roller coaster of the market shake you. Stick to your plan and remember, patience is a virtue in the world of investing. It's not about timing the market. It's about timing the market. Stay tuned for more tips. Stay tuned for more tips. And finally, we address the seventh and equally critical mistake: failing to understand your investments. Imagine jumping into a pool without knowing how deep it is. You could end up in some serious trouble, right?
It's the same with investing.
You need to understand what you're putting your money into, how it works, and what could potentially affect its value. So before you invest, do your homework. Research the company, understand its business model, look at its financials.
If it's a mutual fund, or understand the underlying asset.
If it's crypto, understand the technology behind it. In short, know what you're buying into. And with that, we've wrapped up our top 7 investment mistakes to avoid. Remember, investing isn't a get-rich-quick scheme. It takes time, patience, knowledge, and a well-devised plan. Avoid these mistakes, and you'll be on your way to building a solid and profitable portfolio. Thank you for tuning in. Remember to like, share, and subscribe to our channel for more insightful videos. Stay smart and happy investing, friends.